As we speak, Rezolve AI is trading at $3.80, which is up 2.43% in this morning's session as of January 9, 2026 at approximately 9:50 a.m. Eastern Time. The stock opened at $3.90, hitting a high of $3.99 and a low of $3.77 so far today, with volume already hitting over 4.7 million shares. Most people looking at this chart see a typical small-cap tech stock that has spent the last year fighting through the wreckage of the SPAC market, but there is a massive gap between that price action and the operational scale this company is actually building behind the scenes. While the market treats this like a speculative penny play, the reality is that Rezolve just set a guidance for a $500 million annual recurring revenue exit rate for the end of 2026. That is a massive number for a company with a market cap sitting just north of $1.2 billion. Usually, when you see a valuation that close to projected revenue, either the market thinks the company is lying or there is a massive mispricing happening in real time. If you have been tracking heavy hitters like Nvidia stock or even the steady climb of Apple stock, you know that the big capital eventually flows where the actual utility is. For Rezolve, the expectation is that they are just another chatbot company in a crowded field, but the reality is they have built a proprietary model called Brain Power that is specifically designed to stop the hallucinations that plague generic models. They aren't trying to write poetry, they're trying to sell shoes, grocery items, and luxury goods through mobile devices. They have already moved past the pilot phase with over 100 enterprise customers, including names like H&M, Urban Outfitters, and even Qatar Airways. The expectation is a slow, grinding adoption period, but the reality is a 426% year-over-year revenue growth in their last major report. This is a classic case of a company's fundamental progress outrunning its stock price, which creates the kind of tension that usually leads to a violent breakout or a complete reassessment by institutional players. Looking at the intraday movement, we are seeing significant support forming around that $3.50 to $3.80 range. This follows a period of intense volatility where the stock was hammered down from its 52-week high of $8.45. If you are using an individual brokerage or perhaps managing your own 401k through a Fidelity trading platform, you might notice that Rezolve is starting to pop up in specialized ETFs. It is currently held in the Themes Generative Artificial Intelligence ETF and even shows up in small weights in the Fidelity NASDAQ Composite Index ETF. This institutional footprint is small, but it is growing. When you compare this to the massive retail interest on the Robinhood app or those using Robinhood stock trading for quick swings, you see a battle for control. Retail is looking for the next moonshot, while the institutions are quietly watching the gross margins, which Rezolve recently reported at a staggering 95.8%. The market narrative right now is focused on whether AI can actually generate cash. Most people look at the big infrastructure plays like Tesla stock and think about the physical hardware, but Rezolve is playing in the software layer of commerce. They call it Agentic Commerce. The idea is that an AI agent doesn't just suggest a product, it handles the entire transaction, the fulfillment, and the personalization without the user ever leaving the interface. This is why their partnership with Microsoft is so critical. Microsoft's 35,000-person sales force is being trained to sell Rezolve's Brain Suite. Imagine having that kind of distribution muscle behind a company that most people still haven't heard of. If you are doing your own online investing through interactive brokers or using the SoFi trading platform, you know that distribution is often more important than the technology itself. Rezolve seems to have secured both. Yet the stock remains under the radar for the average investor who is too busy chasing the daily fluctuations of much larger caps. The recent price action is also being driven by a heavy short interest, estimated by some data providers to be around 25% of the float. This creates a coiled spring effect. When a company with high short interest starts putting out news about live enterprise deployments, like their recent wins with Gap and Banana Republic in Mexico, it forces those short positions to reconsider. We're seeing a lot of volume coming in on the buy side today, which suggests that some of that covering might be starting, or perhaps Smart Capital is front-running the management update scheduled for January 13th. This update is expected to provide even more clarity on that $500 million revenue target. If they can substantiate that growth, the current $3.80 price point is going to look like an anomaly in hindsight. Comment below how many shares of RZLV you currently hold, or if you are waiting for a specific price target before entering. I want to see how many of you are actually looking at these small-cap AI plays versus just sticking to the Magnificent Seven. To understand why this company is even in this position, you have to look at what they actually do. Rezolve provides a mobile engagement platform that uses artificial intelligence to make the shopping process seamless. Their Brain Suite consists of Brain Commerce and Brain Checkout. Brain Commerce uses multimodal search, meaning you can take a picture of a dress on the street or talk to your phone about a specific product, and the AI finds it instantly across a retailer's catalog. Brain Checkout then handles the payment, often with one-tap functionality and support for various payment types, including crypto to fiat conversions through their SQD network. They are essentially building the plumbing for the next version of the internet, where search and purchase are the same thing. Their business model is a classic SaaS structure. They charge for the platform, but they also benefit from the recurring nature of enterprise contracts. This is not a company that relies on one-off sales. They have secured millions in renewals and upsells recently, which tells you that the clients who are already using the platform are seeing a return on their investment. This is the reality that contradicts the expectation of AI being a hype-only sector. When a retailer like Liverpool, Mexico's third-largest department store, signs a multi-year deal worth nearly $10 million annually, that is a signal of real-world utility. You don't spend that kind of capital on a whim. The historical performance of the stock has been painful for early investors who bought in during the initial public offering through the merger. It has been a downward slide for much of the past year, which is typical for many companies that went public via SPAC. This has created a lot of bag holders and a general sense of fatigue around the ticker. But this is exactly where the expectation versus reality tension is at its highest. The expectation is that the stock price went down, so the company must be failing. The reality is that the company is currently at its strongest operational point in its history. They have expanded into the LATAM market, opened a new Asia-Pacific headquarters in Singapore, and are now moving into the travel and sports sectors with partners like Qatar Airways. The expectation is a slow, grinding adoption period, but the reality is a 426% year-over-year revenue growth in their last major report. This is a classic case of a company's fundamental progress outrunning its stock price, which creates the kind of tension that usually leads to a violent breakout or a complete reassessment by institutional players. Looking at the intraday movement, we're seeing significant support forming around that $3.50 to $3.80 range. This follows a period of intense volatility where the stock was hammered down from its 52-week high of $8.45. If you were using an individual brokerage or perhaps managing your own 401k through a Fidelity trading platform, you might notice that Rezolve is starting to pop up in specialized ETFs. It is currently held in the Themes Generative Artificial Intelligence ETF and even shows up in small weights in the Fidelity NASDAQ Composite Index ETF. This institutional footprint is small, but it is growing. When you compare this to the massive retail interest on the Robinhood app or those using Robinhood stock trading for quick swings, you see a battle for control. Retail is looking for the next moonshot, while the institutions are quietly watching the gross margins, which Rezolve recently reported at a staggering 95.8%. The strongest bullish case for Rezolve rests on a few critical points. First, their gross margins are phenomenal,
at 95.8%, they are operating at an almost pure software-as-a-service model, which means as they scale revenue, more profit drops to the bottom line. Second, the customers they have secured are not small-time players. When you have relationships with H&M, Urban Outfitters, and K3 Biz Software, you have validated your technology at the highest level. Third, the distribution channel being handled by Microsoft Salesforce is a major advantage. This kind of access to enterprise clients would typically cost a company hundreds of millions in marketing spend. Finally, the short interest creates the potential for a rapid price movement. If the good news continues to come in, the shorts will have to cover, which could lead to a significant short squeeze. The weakest points in their case are around their cash burn, the general sentiment surrounding SPACs, and the reliance on an angle framework that many investors find confusing. If you have been following AI stocks, you know that the market is unforgiving of any perceived weakness. For Rezolve, the cash burn is the big question mark. They have not yet reached EBITDA